As traders, we all want those sniper entry, the kind where price taps your level, reacts instantly, and just takes off. Clean, precise, no stress. But most people never get that. On the other hand, some traders take trades with a low risk to reward ratio, and some of the trades can be refined to get a proper and high reward ratio. For example, this is a 1.9 risk-reward trade, which essentially means you will risk 1% to make 1.9%. That means you are risking $1 to make $1.9, and so on. This is okay, but the risk-reward isn't great. And it's not exactly a sniper entry. It's not a trade that's gonna bring you a massive reward. And if you take trades like this all of the time, yes, you can be profitable, but you're kind of on the edge because the risk-reward isn't that great. This is the same exact trade, same exact target, same selling area. But because we refined it, we turned that 1.9 risk-reward trade into a VIX.25 risk-reward trade, which means you're risking 1% to make 6.25%. You're risking $1 to make $6.25 in return, turning the same trades into massively profitable positions just by refining the zones to get a beautiful sniper entry. In this video, you will learn how to enter at the exact point where the price is ready to move. You will learn the basics of supply and demand theories, multi-time frame analysis, zone refinement, and how they play a big role in getting perfect entries on your trades. Let's get into it. Let us start with demand and supply zones first, because if you do not understand this part properly, refinement is not going to make sense. So, a demand zone is simply an area where price paused before making a strong move to the upside. When you are looking at a candlestick chart, this is usually going to be that last candle sitting at the base before price just explodes higher. If we turn it into a zone, we mark it out as a box. There are different ways people draw their zones, but the easiest way, and the way I like to keep it simple, is to use the last candle before the impulse move away. So what am I looking for? I am looking for a candle that is moving sideways, maybe with wicks on both sides, not doing too much, and then right after that, price pushes up aggressively. That is important because what that is showing you is that heavy buying likely took place there before. Big money stepped in. Institutions placed large orders there. That is why price did not just move up slowly. It left that area with force. And that is what a demand zone is really telling you. Now, why does that matter? Because that zone is seen as a discount price. It is an area where buyers previously found value, so when price comes back there again, we expect buying interest to show up once more. That is why when price retests a demand zone, we look for buy setups. We are expecting that same kind of institutional buying to react from that level again. Now, supply is just the opposite. A supply zone is an area where price paused before making a strong move to the downside. So instead of price exploding up, it drops hard from that level. Again, we draw it as a box, and again, I keep it simple by using the last candle before the impulse away. That is the easiest and cleanest way to market. What is a supply zone showing you? It is showing you a price where heavy selling took place before. Institutions sold from that level. Large sell orders entered the market there. That is why price dropped hard from it. So, when the market returns back into that zone, we treat it as a premium area to sell from because we expect more selling to come in again. That is why we look for sells on a retest of supply zone. So that is the basic idea. Demand is where we want to buy from. Supply is where we want to sell from. And once you understand that, then we can start talking about how to refine these zones so we can stop taking average entries and start getting those proper sniper entries. So let's move over to zone refinement. All right, let's say we are on the 4-hour time frame and we spot a supply zone. Price has not come back to it yet, but we already know that if it returns there, we want to look for a sell. Nice and simple. Price then starts retracing back up into that 4-hour supply zone. If we place the trade straight from that zone and our target is just the recent low, it means our position may look like this. Now, this is a 1.9 risk-reward trade. Now, what does that mean? That means you are risking 1% to make 1.9%. You are risking $1 to make $1.90. That is not bad. It is okay. You can still make money with that. But to be honest with you, that is not the kind of trade that gets you excited. That is not a sniper entry. That is not the kind of setup that gives you released return for your risk. And if most of your trades look like that, yes, you might still be profitable, but your margin is small. Your reward is not that impressive compared to the risk you are taking. So, what do? This is where refinement comes in. Instead of just taking the whole 4-hour zone as it is, we go inside it. We drop down to a lower time frame and look for a smaller zone sitting inside the bigger zone. So, in this case, we move from the 4-hour time frame down to the 1-hour time frame. So, here's an example of what the 1-hour time frame might look like. If we were to map on the 4-hour zone, it may look like this because it's going to be covering a broader range of candles. But what we can actually do now is refine this supply zone to a smaller 1-hour zone that exists inside of the 4-hour zone. We see further imbalance and we see a smaller supply sitting at the top. Now, what this allows us to do is use this for our positions, okay? So now you can see we've dramatically amplified the risk to reward on this position. If we take it back to the 4-hour time frame, our 4-hour zone refined to the 1-hour zone would look like this, meaning our position would look like this. Same exact trade, same exact target, same selling area. But because we refined, we turned that 1.9 risk-reward trade into a 6.25 risk-reward trade, which means you're risking 1% to make 6.25%. You're risking $1 to make $6.25 in return. So we're turning the same trades into massively profitable positions just by refining the zones. And we get that beautiful sniper entry. Let's go look at this on a real chart. This is the 4-hour time frame. We're looking at a market which has just shifted in trend direction. So we see a break of structure here, which has taken us from lower lows and lower highs into higher highs and hopefully a higher low for us to take a trade from, all right? So that's the basic trade concept. Now, we're gonna use the similar technique as previous. Targets-wise, we're just gonna look at the swing high. So all we're gonna be looking for, just like the examples I showed you, is a trade from there to there, okay? Now, we can go ahead and mark out the last candle before the impulse. That's gonna be our demand zone, which in this instance would be plotted on like this, okay? So, not bad. Pretty nice little demand zone. If we were to map out our long position, we would have an entry there, stop loss under there, and a target up into that high. Now, This is a 3% trade, so it's by no means a bad position. This is something I'd be happy to take. You could get in from here and run it up to here. But we are talking about getting sniper entries, so let's follow that rule now and go from the 4-hour down to the 1 hour and see if we can find a refined opportunity. Dropping down to the hourly time frame, we see immediately more candles open up. Basically, what we do here when we go from the 4 to the 1 hour is times the amount of candles we get by 4, right? Because we're seeing 4 candles per each individual 4-hour candle. Now, we have 2 areas. One area of demand here, which is the last candle before this impulse away, and another here, this larger one at the bottom, which is the very low of this market. And this, again, is a last candle before an impulse away. So, at this point, we can work out what to do in terms of zone refinement and see what we've got in terms of opportunities to increase the risk reward. For a moment, we're going to remove this one. We're going to focus on this lower one because this is where we can refine our hourly buy limit order to. So from the 4-hour position of 3.08%, if we were to move our entry to the top of this zone without changing anything else about the trade, we are now at 5.58 risk reward, which means in this instance, we have added 2.5% potential to the exact same trade. And all we had to do to get there was drop the time frame from the 4-hour to the 1 hour and refine to this level. Now I want to take it back to the zone just above because the question might be there. How am I going to pick between these two zones? See, sometimes when you go to a lower time frame, you're gonna see multiple zones inside of what was once just one zone, and this can make things a little tricky. Now, there's a simple way that we can approach this outcome. Before we move on to our new position, we're gonna talk about that real quick. So, if we now have 2 zones to choose from, we don't know where to place our order. We have a video on how to pick the right zone on the channel. You can go ahead and watch the video from the card up above or the link in the description below. For the sake of this video, let me give you a little tutorial on that. The simple way to approach this is to place your order on what we call the extreme zone, okay? Now, the extreme zone is going to be the furthest zone from price in the leg of price movement. So our leg of price movement is from this low to this high, okay? This is the bullish push. We're basically now looking for a retracement opportunity to then buy from further. Inside of the first leg of price action, which is this one here, the extreme zone is gonna be the furthest zone from price. So the lowest possible zone in a buying scenario. That makes this zone the extreme zone. If we want to place a buy limit on either of these zones, the standard one to go for is gonna be the extreme. First of all, because we get the best risk reward from this zone, and second of all, because it's just the safest one. If we go ahead and place an order at this zone, for example, and our stop loss is here, we can be right on this position, meaning we could actually be correct about the market direction, but we could still be stopped out if the market decides to reach for the extreme zone. So when it comes to buy limits, the safest way to do this is to just place your order at the extreme zone, which in this instance is going to be that 5.58 risk reward or 5.58% potential return trade. Now, to approach this one, we have got to think the market could react from there. If it does react from there, we are going to miss the trade if we are focused only on the extreme. So, what we can do inside of the top zone is use what I call a standard confirmation. This is nothing new. It's just a simple name for a simple approach to structure confirmations in your trading. So a standard confirmation looks just like this, okay? What we would do is when the market reaches this level, we would see if this lower time frame structure changes in agreement with our larger trend direction. So now that we're on the hourly, we can see there's a small trend inside of the larger trend. We have the high, a low, lower high, lower low, then we have a lower high and a lower low. Now, at this point, we would basically want to see the market return into this area of demand and then create a new high. If we saw this, let's say it happened immediately from where the market is right now. So if we had a drive down from here, retest of this level, and then a push back above this point, this would confirm that the top zone could indeed be good for a position, because what it would show us is that this demand zone is seeing an influx of buying that's strong enough to reshape the trend, okay? So if we were able to push over a previous high, it would tell us this zone has more strength than we may have initially anticipated, and that means, therefore, we could take a buy position if the market was to pull back. So from there, we would identify demand, and we would buy from that point to take the trade up towards our target. So once the market reached this point and closed up here, that would be a good time to confirm that you are able to put buy limits on this area quite safely. So that is how we would approach multiple zones. Now, just to give you an insight into what the standard confirmation looks like in reality, let's just take a look at how we found the premise for this trade. Here we have overall a downtrending market. Then we come down to this low, and then a push up to this high. This is that structural shift that we would want to see. So basically, we would take this pattern that we have got right here, and we would replicate this on a smaller time frame, okay? So we'd be looking at that exact same thing again. If we got that, we could then happily place orders, all right? So that's a visualization of what the standard confirmation looks like in the candlesticks. So that's how you would pick between two zones. Just go with confirmation entries on any top zones, and then the lower zone, the extreme zone, the furthest from price at the bottom of the leg of price action is where your order can be placed. You could place a buy limit there because you would be quite happy to get in at that point if the market got to it. So if we jump back to 4-hour time frame now, we can see that we have our top zone for potential confirmations, and we have an order placed at the extreme zone. Now, just removing this one for a moment, we can see that now the 4-hour candle basically has a zone covering half of it. On the 4-hour first glance, it doesn't really seem to make much sense, but that's because this is a 1-hour zone, okay? So this is our 1-hour extreme zone. The idea here is then that we have actually managed to refine the trade down, and rather than getting in at this high, we are going to be getting in at the extreme, the refined area, which is going to give us the best risk reward for this trade, okay? Now, let's see how this market runs out. See, we get pushed down into that extreme zone, and then the market pushes up and makes its new high, which would fill our trade target. And just to show you, if we were working with the 4-hour zone, well, the high of the zone would be there. The low of the zone would be there. So our position would look like this. Okay, so we're looking at around a 3% return without refinement, or we're looking at that 5.58% return with refinement, which, as you can see, as well is where we get those sniper entries, because what we have actually done is managed to secure an entry right on the wicks. We're not halfway through the candle bodies, we're not completely above one of the candle bodies, as we would be if we had entered off the 4-hour zone. We have captured the wicks, and we have secured a sniper entry. Now, there's one thing you've got to watch out for when refining zones, and that's over-refinement. You don't want to refine your zones too far. You might be thinking, if we go from the 4-hour to the 1-hour and it tightens the zone, giving us a cleaner entry, why stop there? Why not drop down to the 5-minute or even the 1-minute? Surely we'd get an even smaller zone inside the bigger one, right? Problem is, if we zoom in on the 5-minute and dig into this larger demand zone, we're actually going to find these zones way down here at the low. So you might look at this demand zone and think, okay, this looks solid. There's still some imbalance into this, so maybe I place my entry here, and my risk-reward looks absolutely massive. The issue is, the market isn't always going to reach those levels. So yeah, on paper, this trade looks incredible. Maybe 23R, meaning you'd make 23% for every 1% risked. But the reality is, most of the time, it's just not getting hit. We're working off 4-hour and 1-hour price action here, so dragging the market down this far to the 5-minute is a dangerous game, and you're gonna end up missing positions. Don't over-refine. Don't take it too far, or you'll just watch good trades sail past you. Now, here's a simple rule to make sure you don't over-refine and blow all your setups. Go 2 steps down. 2 steps down means if you're on the 4-hour, you can drop to the 1-hour, and at most, down to the 30-minute. If you're on daily, you can go to the 4-hour and maybe the 1-hour. If you're on the 30-minute, you could hit the 15-minute and potentially the 5, but we never really want to go much lower than that. Step down 2 default timeframes. Generally though, you probably only need to go 1 step down to lock in sniper entries and seriously amplify the profit potential of your trades. You saw from this position, we added 2% onto the trade. If you can pull a 5% trade, 5.5%, that's all the profit you need for a very healthy month of trading. Taking a trade from 3 to 5.5 and pretty much doubling the returns just by shifting your entry to a slightly lower time frame, that's solid, and you don't want to get greedy and push it too far. Now, while we're here, let's take a look. We're on the 30-minute time frame. If we refined our zone to the 30 instead, we'd have had this area to work with. I'm still a fan of putting stops under the low, so I'd keep that there. But we could have squeezed potentially another little bit of profit out of it and turned this into a 9% trade by following that 2 steps down. 4-hour, 1-hour, then 30-minute. So by going from 4-hour to 30-minute, we actually tripled the profit potential of this trade. But if we keep going and drop too far, say down to the 5-minute, we risk missing this trade entirely. That is all for the video. Thanks for watching. Don't forget to subscribe, and I'll see you in the next video.